JEPI and JEPQ are two of JP Morgan's most popular ETFs, and they've exploded in popularity, attracting over $71 billion of assets and a loyal following of income investors. That's, of course, because both pay massive monthly dividends, but the real question is, which is the best to buy? And while they may look similar at first glance, once you peek under the hood, you'll see they're built very differently. In this video, we'll unpack everything: key metrics, total returns, sector breakdowns, hidden tax traps, and ultimately, which ETF is the better buy. But real quick, before we get started, many of the charts and comparisons in this video come straight from Dividend Watch. It's the easiest way to automatically track your dividend income, forecast payouts, and discover new high-yield stocks and ETFs, including our top stocks shortlist. There's a link in the description below to sign up for free, and if you want to unlock the most popular features, you can use code YouTube at checkout for a 7-day free trial and 20% off a pro annual plan. Now let's dive in. Two reasons why JEPI and JEPQ have become so popular are their sky-high yields and monthly payouts, which far outpace what you'd get investing in NASDAQ or S&P 500 stocks. They can do this by deploying what's called covered call strategies. That's the secret sauce behind those big payouts. Now, we're not going to dive into every nuance of option mechanics here, but here are the Cliff's Notes for how covered calls work. Covered call funds like JEPI and JEPQ own a basket of stocks, and then they sell out of the money call options to collect a premium, which is then paid out to the fund holders as part of the monthly dividend. But of course, this monthly income comes with a trade-off. When the market goes higher, those call options cap the upside for each stock, meaning you don't capture the full price gains like you would in a traditional ETF that doesn't sell call options against its holdings. Now, here's where the two ETFs diverge some. With higher volatility comes higher potential option premiums. JEPI is built on a portfolio of low volatility and more defensive S&P 500 stocks, so it's diversified across sectors. Think healthcare, industrials, technology, financials, and more. It's designed for steady performance and smaller drawdowns. JEPQ, on the other hand, sells calls on the NASDAQ 100, which is dominated by tech and growth stocks, names like Apple, Microsoft, Nvidia, and Alphabet. That, of course, makes it more sensitive to market swings, and the added volatility helps generate higher yields through option premiums. Now, options mechanics aside, let's talk dividends and performance. Those are two of the main reasons you're probably watching the video today. JEPI's yield sits at 8.3%. JEPQ is even higher at 10.2%. But higher yield often signals higher risk, and we'll see that play out in their holdings shortly. Now, crucial for any dividend ETF, their expense ratios are reasonable for actively managed ETFs at about 0.35%, but a far cry from large passive index ETFs from Vanguard, Schwab, and others, where essentially it's a race to the bottom for the lowest cost offering. When it comes to performance, the gap between these two has widened in recent years. It's not just about yield. Looking at total returns, that's price plus dividends, JEPQ has pulled ahead with 23.2% 3-year annualized growth, compared to just 10.1% for JEPI. But let's review what those returns mean in practical terms. I've created a portfolio inside Dividend Watch with $10,000 invested in JEPI and JEPQ for the past 3 years. The monthly income view starts to tell the same tale of differing performance both in total income potential and price returns. Reviewing annual income first, you'd be earning $93 per month in JEPQ and $58 in JEPI, for a total of around $150 per month in recent times. Annually, that works out to around $1,960 in income for JEPQ and JEPI combined. But let's dig a level deeper, since income is only one part of total return. Unsurprisingly, with the tech boom in the past years, the performance between these two has diverged. Of the total 51% return notch for JEPQ, roughly 13 percentage points of that comes from dividends, and the other 37% from price gains. JEPI is a different story, though, with total returns coming in at 24%, with dividend income more than making up for the price loss during that time frame. But these differences aren't because JEPI suddenly stopped working. It's a reflection of what's under the hood. JEPQ's tech-heavy exposure has driven outside gains on the back of the AI boom, JEPI's broader, more defensive portfolio has held up well in choppier markets, but it simply doesn't have the same horsepower when growth stocks are leading the charge. Now let's pop the hood and see what's really driving the performance difference. JEPI is a definition of diversification. It spreads out its exposure across the market, roughly 19% in technology, 13% in financials, and 13% in healthcare as well, with basic materials being the only sector not receiving an invitation to the party. JEPQ, on the other hand, unapologetically tech. More than half the portfolio, 54%, sits in technology. In other words, if the NASDAQ's having a good day, JEPQ probably is too. You can further see this difference in their top holdings. JEPI's top 10 are familiar blue chips, but each company makes up around 1.5 to 2% of the fund. JEPQ flips that script. NVIDIA 8.5%, Apple 7.2%, Microsoft 6.7%. You get the picture. That concentrated tech exposure is what gives JEPQ its personality. Higher highs when tech rallies, but sharper drawdowns when sentiment turns, and a higher yield to say thank you for buying in, of course. But before you fall in love with those 8 to 10% yields, remember that Uncle Sam takes a bite too. And not in the same way if you were to invest directly in any of these stocks or run of the mill dividend ETFs. Most of the income generated from covered call ETFs is considered non qualified, taxed at your ordinary income rates, not the much lower qualified dividend rate you'd get investing directly in dividend paying stocks. But in short, the average investor's after tax yield would be roughly 20% lower than the headline yield, or about 6.5% for JEPI and 8% for JEPQ. That's a big haircut investors don't talk about, making a pretty strong case for investing in these two ETFs and tax advantaged IRAs. Now that there is clarity around taxes and their impacts, we can move to another common question. Are JEPI and JEPQ good drip investments? To answer that question, let's actually hop back into our $10,000 portfolio to see how DRIP impacts total returns for each ETF. As we saw before, the total return for JEPQ over our measurement period, roughly $5,100 or 51%. With DRIP enabled, the modeled returns impressively jumped to $11,300. JEPI is a similar story with DRIP enabled, boosting total returns to around $6,400 compared to roughly half that amount when pocketing your monthly dividends. Now, here's where it gets really spicy. The total annualized portfolio return jumps to 12.6% with DRIP enabled for both ETFs, a massive increase from just about 2% without reinvesting. And that performance difference cuts to the core of why JEPI and JEPQ are so popular with income investors, especially if you're reinvesting those high yield monthly payouts. So, after all the stats, yield details, holdings breakdowns, all the insights and tax implications, the one remaining question we have today: which one should you buy? Let's start with JEPI. This is the ETF for investors who favor consistency and calmness. Think of JEPI as a steady S&P 500 with a monthly paycheck. It's not going to shoot out the lights in the bull markets, but it also won't give you heartburn when things get rough. JEPQ, on the other hand, lives on the other side of the spectrum. It's built for investors who are comfortable with volatility, who want exposure to the tech-driven NASDAQ, and who understand that bigger swings can mean bigger gains, and at times, bigger drawdowns. But keep in mind, it doesn't have to be one or the other. Some investors actually blend the two, using JEPI for defensive or reliable income and JEPQ for a more growth-oriented boost. But perhaps most importantly, JEPI and JEPQ are income tools, not traditional wealth-building machines. Dividend growth investors build wealth through a combination of compounding price and dividend growth. Retirees, on the other side, preserve wealth through protection. These two funds, they live in the middle. They generate income, but they don't replace a dividend growth or a low risk retirement income strategy.